Ladies and gentlemen, friends, colleagues, very good morning. Welcome to the fourth edition of SFF. This is actually also the first edition of combined SFF and Switch. We have come a long way since we began our FinTech journey 2015, 4 years ago. And Singapore is widely recognized as one of the leading FinTech hubs of the world. And as shown in the opening video, we have remained true to our vision. Harness the power of technology and innovation to increase efficiency, manage risk better, create new opportunities, improve people's lives. And as Ravi has mentioned, we are making green finance a major theme of this year's FinTech Festival. Finance, technology, innovation, it will be critical for our transition into a sustainable world. And as Pavan from WWF has just presented, I think he gave a very eloquent, very compelling case for why green finance is so important. And Singapore, we will do our part. As a responsible global citizen, to reduce carbon emissions and help make the world greener. As our Prime Minister, Mr. Lee Hsien Loong, he said recently that climate change is the ultimate global commons challenge. In Singapore, we account for 0.11% of global carbon emissions. So by our actions alone, we cannot change the world. But we hope through our actions, we can inspire the world, we can catalyze change for the world. We are developing our long-term low-emission strategy. We are not building up from scratch, but from a fairly strong foundation. What are some of the things we have already done? For many years, in fact. First, we are one of very few countries in the world, and I believe the only one in Asia, to have introduced a broad-based carbon tax, and we put a price on emission. We are also one of the few countries in the world where we limit our car population and we price the usage. Today, what is the growth of the car population in Singapore? It's 0%, and it has been so for a few years. We put a limit to it. As a principle of planning, we build greenery into our cityscape. We put a natural reserve in the middle of the city. We systematically create wetlands, mangrove swamps to absorb flood water and cushion storm surges. Today, we have a linear system of make or take, make, and then dispose for the things that we use. Our zero waste master plan will transform this. Will transform Singapore into a circular economy, one that reuses resources in a continuous loop. Our next ambition is to leverage green finance to make the world greener. Finance fuels economy and businesses. It determines investment decisions. It drives action. We must make finance green to drive climate action. As a leading international financial center, Singapore will do the right thing to help reduce carbon emissions, promote sustainable development in Asia and beyond Asia globally. What does it mean to make finance green? It means what the Paris Agreement says. I quote, making finance flows consistent with a pathway towards low greenhouse gas emissions and climate-resilient development. And that, in turn, means mobilizing global capital for the green economy, channel them to new investments in green businesses, technology, infrastructure, reduce carbon emissions while creating jobs and opportunities. It means a virtuous cycle that can bring about economic growth that is environmentally sustainable. And the last point is particularly important because economic growth remains critical to many people living in this world. It is inconceivable to tackle climate change and bring about a sustainable world by telling the developing world that you cannot grow. They have to give up your dreams of economic development. So for many developing countries in Asia and in many other regions in the world, they are still urbanizing. Populations are still aspiring to catch up from lower to middle income living standards. And energy demand is still rising in these countries. Their solutions cannot be to curtail their growth and dampen their hopes. That is why in 1992, the United Nations Framework Convention on Climate Change, the UNFCCC, it established the CBDR principles. Many of us should be familiar with that. Common but differentiated responsibilities, which form the basis of the Paris Agreement. So we must dare to believe that we can bring about growth that is sustainable. It means making a quantum leap in improving energy efficiency, in shifting the energy mix, including investing in renewable energy. And what is the extent of the change that is needed? The IEA has developed a Sustainable Development Scenario 2040. So under the 2040 scenario, the world achieves universal energy access, yet reduces air pollution, and is on track to meet the goals of the Paris Agreement. And in this scenario, the use of fossil fuels falls by a quarter, while hydro and renewables increase fourfold. The ratio of fossil fuels versus hydro and renewables shifts from 20:1 to 3:1 by 2040. And this shift is accompanied by continuous improvement in energy efficiency. And it is not a pipe dream. It's not just David Attenborough says so, because with technological advances, the widespread deployment of those technology and green finance, I think we have a good shot at achieving it. IEA estimated that full utilization of currently available, economically viable, energy efficient technologies in industry, buildings, transport, that alone will reduce global emissions by 11% from today's levels. They already exist, we just need to deploy them. From 2008 to 2017, coal's share in China's energy supply fell from 70% to 64%, as renewables rose from 3% to 6%. This China did on its own, and subject to market forces. And to a large extent, this is because renewables costs have fallen due to technological advancement. And at the frontier, renewables are more economical than fossil fuels. In fact, solar, wind power are highly competitive in the United States. And it can be cheaper in many other regions, like ASEAN in Southeast Asia. ASEAN has set an aspirational target to increase renewables from 10% in 2015 to 23% of energy mix by 2025. And today, we are almost halfway there. We are at 15%. And in addition, we can use smarter grids, we can have greener buildings, and battery storage systems to overcome the power of intermittency when we use renewable energy. And these are significant changes because Asia represents about half of the world's global emissions and half the world's population. If Asia shifts, I think the world shifts. The shift in energy mix has to be determined but progressive, in tandem with technological advancements, and not sudden, not disruptive. It is not realistic to replace fossil fuels with renewables suddenly and overnight. But we have to make progressive and determined moves. There is a lot that we can do in green finance to bring about this shift in emission situation I just mentioned. Globally, finance is actually still quite well behind the curve. Fossil fuel financing, for example, is still very significant, totaling US $1.9 trillion over the 3 years following the Paris Agreement, with financing still rising every year in this area. And surely the trend should start to reverse, given that energy mix has already started shifting. Green bonds have started to take off, but very nascent, and form only a sliver of total bond issuance. Last year, green bonds issuance was US $168 billion. That's 2.5% of total bonds issuance last year. Singapore's financial sector has played a decisive role in promoting sustainable development, opportunities, powering the transition, and especially in Asia. We can spur investment in renewables technology, in grid infrastructure, in battery storage. We will also need investments in green buildings, efficient cooling and industrial systems to optimize energy consumption. In time, maybe even bring about investments in carbon sequestration. And with our experience in financing the region and capabilities in technologies, we can make a unique contribution here in Singapore. Our vision is to be a leading center for green finance in Asia and globally. Today, let me outline some of the concrete steps that Singapore is going to take. And there are 3 major steps, and let me elaborate them. The first is to build a financial system that is resilient to environmental risk. And second is to develop green finance solutions and markets. And third is to leverage innovation and technology. Let me start with the first. Building financial systems resilience to environmental risk. Climate change poses 2 main risks to our financial systems. Number 1 is physical risk, arising from climate change itself, damage to assets and property caused by floods and rising sea levels. This can result in large insurance claims and lower the collateral value of bank loans. So over the last 30 years, the annual average worldwide cost of natural disaster is US $140 billion. That's the average in the last 30 years. In the last decade, 7 out of 10 years exceeded this 30-year average. So you can imagine the trend going up. At the temperature rise of 2 degrees, US $1.7 trillion of global financial assets, or about 2% of total global GDP today, are estimated to be at risk. Number 2 is transition risk, arising from policy changes, from changes in consumer preferences, or technological advances. Old fossil fuel assets can become stranded, and as a result, we devalue the loans and investments in the energy sector. The amount of stranded assets across the energy industry and building sectors from now to 2050 could be up to US $20 trillion globally. And these potential losses are huge and can be compounded by other risks, such as deforestation, land contamination, water and air contamination, pollution, threatening the stability of the financial system. Our financial institutions need to build up their resilience to climate change risk. And this encompasses measuring, mitigating, and disclosing this risk. First, measuring the risk. This is about risk assessments and forward-looking stress tests. What would asset values be when sea level rise and carbon prices further increase? banks, insurers, asset managers will need to assess the impact of climate change on balance sheets and their loan and their investment portfolios. The industry is beginning to move, and it has to move a lot more quicker. Global regulators, including MAS, are intensifying their supervisory focus in this area. MAS is working with our counterparts to enhance global practices in environmental risk management and disclosures. We do this through two networks. One is the Network for Greening the Financial System, the NGFS, of which we are a founding member, and the other is through the Sustainable Insurance Forum. Second, mitigating risk. And this is about limiting and reducing exposures. The Association of Banks in Singapore, the ABS, has issued guidelines on responsible financing practices. Our three local banks, DBS, OCBC, UOB, have ceased financing new coal power plants as they step up their financing of renewable energy projects. Asset managers in Singapore have signed the UN Principles for Responsible Investment and developed the Singapore Stewardship Principles for Responsible Investors. Financial institutions, too, should make early strategic shifts in capital allocation from carbon-intensive to greener businesses, or risk being stuck with environmentally unfriendly stranded assets. And third is disclosing risk. And this is about providing sustainability-related disclosures to better inform our investors. Within Asia, India, Hong Kong, and many exchanges in ASEAN, including the Singapore Stock Exchange, have implemented sustainability reporting for listed companies. And this is a good start. But companies and financial institutions should enhance the quality, the granularity, and consistency of those disclosures for investors to make well-informed, better decisions. To reinforce industry efforts and build financial system resilience, MAS will issue environmental risk management guidelines across banking, insurance, and asset management sectors. These guidelines will set standards on governance, risk management, as well as disclosure. The guidelines will encourage the right pricing of loans and investments, and therefore promote new investments for green investments, promote new opportunities for green investments. MAS will publish a consultation paper in the first quarter of 2020. Now let me move on to the second thrust of our action plan, and that is to develop green finance solutions and markets. And this will provide new economic opportunities in clean tech and other growth areas by financing the investments that these green sectors will need so that they can grow. Greening the financial system requires a range of instruments, starting with green bonds first. MAS introduced a green bond grant scheme 2 years ago. To date, more than $6 billion of green bonds have been issued. The grant defrays the cost of external review against green bond standards. We have expanded the scheme by reducing the minimum size, broadened the scope to include social and sustainability bonds, and we also rename it. Now it's called the Sustainable Bond Grant Scheme. And we welcome more issuers to make use of the schemes and issue more of such bonds here. For green bond markets to reach scale, we need common green bond standards. This is to avoid fragmenting the capital pools across borders and tackle the problem of greenwashing. And this is the malpractice of making projects look green when they are actually not green. We have to tackle the problem of greenwashing. And globally, there remains important work to harmonize green bond standards for better comparability. But that said, there are already standards that exist and fit for use by issuers. One example is the ASEAN Green Bond Standards, which provides a regional framework for cross-border issuance. We had worked with our ASEAN partners to develop and update the ASEAN standards to be in line with international green bond principles. Other than green bonds are green loans. To make finance green in Asia, we need to make green loans and green lending not just a niche activity, but a mainstream lending activity. And banks are the main source of financing here, particularly in Asia, where capital markets are still developing. But green lending in this region is actually more nascent than green bonds. This is therefore an area, we think, where there's significant potential for growth. And we are beginning to see early shoots in green lending. In the real estate sector, for example, many developers have secured green loans from banks to develop green buildings, install solar panels, retrofit buildings with energy-efficient equipment. In the broader market, sustainability-linked loans are also gaining traction. And here, loan proceeds, they are not tied to any specific green project, but for general corporate users, so long as the borrowers meet sustainability matrix. And recently, Quandria Capital, a private equity fund in Singapore, became the world's first to tap on sustainability-linked loans for private equity. And we wish to see more of such developments. MAS will develop incentives to encourage growth in green and sustainability-linked loans. In order to access lending, firms will need to incur costs to develop sustainability frameworks and also to engage external reviewers. So MAS will develop grant schemes to help defray this cost for businesses. The third area is risk transfer solutions. In insurance, we need to develop new risk transfer solutions that will help meet disaster protection needs while creating alternate investment opportunities. We established the Southeast Asia Disaster Risk Insurance Facility, or CDRIF, with support from Japan and the World Bank. CDRIF provides flood risk pooling and strengthens the region's disaster resilience. A good example of risk transfer solution to promote green finance is the ILS, insurance-linked securities, which enable returns and risk to be distributed to investors via the capital markets. And to catalyze the growth of ILS market in Singapore, MAS introduced an ILS grant scheme last year to fund the upfront issuance costs. And since then, we have seen the first catastrophe bond domiciled in Asia and 3 catastrophe bonds issued. And ILS can be used to transfer other risks, not just catastrophe risk, and support the development of new climate risk insurance. MAS will study extending our ILS grant scheme beyond year 2020. Fourth is green funds. MAS will issue and will launch a US $2 billion Green Investment Program, GIP. Under the program, MAS will place funds to public market investment strategies which have a strong green focus, with asset managers who are committed to deepening green finance activities and capabilities in Singapore. This program also supports MAS efforts to generate sustainable long-term returns on its investment portfolio. It complements our broader range of initiatives to accelerate the growth of Singapore's green finance ecosystem. As part of the GIP, the Green Investment Program, MAS will also allocate US $100 million to the Bank for International Settlements Green Bond Fund in support of its global green finance initiatives. And finally, green capabilities. As we develop solutions and markets, we need to build the requisite capabilities in green finance. We are collaborating with our universities, the Asia Sustainable Financial Institute Initiative, and the International Finance Corporation to build up capabilities amongst financial industry professionals. MAS will develop a scheme to support external reviewers and rating agencies who assess and certify green financing instruments and encourage them to expand their operations here. MAS will also work towards anchoring centers of excellence in Singapore to contribute to Asia-focused climate research, which can be applied in the financial sector. The centers will support development of innovative green finance solutions, deepen our understanding of climate risk, and enhance climate risk management in Singapore. The centers will also train, groom, nurture talent in this area. And we have received keen interest from leading international research institutes and universities to collaborate with our local universities to establish these centers of excellence. Building such capabilities is extremely critical. And this brings me to the third thrust of our green finance strategy, leveraging our strong FinTech ecosystem and the capabilities and technologies it has to offer. Since we started our FinTech journey, we have built up a strong base of technological capabilities, and we will build green finance on top of this technology stack. We will harness the power of FinTech to spur green finance by scaling up reach, innovation, and data. RID, reach, innovation, data. We are already beginning to see interesting FinTech solutions for green finance. First, reach. We will encourage the application of platform technologies for green finance to reach a wider pool of capital and market players. We can use such technologies too to connect supply chains. Bureau Vaughan's Uganda develops digital platforms to monitor crops and financial transactions across supply chains, and to track data on top of crop yields, to track data on crop yields and the sustainability of farming practices. Second, innovation. We will encourage the development of smart algorithms, smart contracts, distributed ledgers to increase speed, ease, transparency of transactions. Solstrom developed a blockchain system for generation and transaction of carbon offsets. The system auto-generates carbon offsets, complete with timestamps and geotags using emission data from smart meters. And the records are secure, is tamper-proof, and is also transparent. Third, data. We will promote the application of big data and advanced modeling to measure climate and financial risk, develop new climate risk insurance products. For example, Asia Risk Transfer Solutions developed a cloud-based risk analytics software for designing and pricing agriculture and natural catastrophe risk insurance products. And this is just the tip of the iceberg. Many more ideas and applications will emerge. Every year, as part of the SFF, FinTech Accelerator, we gather and publish problem statements around key themes for FinTechs to develop solutions. And this year, there were vertical themes for banking and insurance, and the horizontal theme of financial inclusion. And next year, we will introduce green finance as a key horizontal theme for the 2020 FinTech Accelerator. It will be exciting to see what new FinTech solutions will come up from SFF 2020. Now let me conclude, and I shall conclude by going back to our larger purpose and why this is important. Finance, innovation, technology, I think these are forces for good to overcome challenges and improve lives. Climate change is the ultimate challenge for humankind. It cannot be that being green and pursuing growth, and these two objectives are irreconcilable. Cannot be. With imagination, innovation, technology, determination, I think we can reconcile the two. part of this solution is to make finance green, because finance mobilizes the resources of the world. I have therefore laid out our vision for Singapore to be a leading center for green finance, promoting sustainable development in Asia and globally. Thank you, and have a great FinTech Festival.